Hello students, and welcome to this video on property, plant and equipment. This question is called Bonbon Limited. I've made it available to you so you can go and retrieve it before you look at this question. So question 4 says that Bonbon is an entity that owns several property, plant and equipment, and the following information is provided. And they give you a summary in terms of a block where they provide you with 4 different assets: land, buildings, equipment, vehicles. And then they give you the cost price, the date of purchase, which is very important in terms of calculating accumulated depreciation. They give you the depreciation method, which is straight line in all instances except for land. Then they provide you with the useful life in years. You will see land is infinitely used, while the others have a useful life of 25, 10, and 5 years respectively. Then they've given you a residual value only in one instance, which is for the buildings. And then there's a valuation model provided. You will see that land is carried on the revaluation model, but it's not depreciated. And the buildings, equipment, and vehicles are carried on the cost model. In the additional notes, note number 1, it says that on 28 February 2050, equipment with a cost price of 100,000 rand was scrapped. The equipment was insured for only 70,000. So here we have a scrapping of a bit of the equipment. You will see the total for equipment is 500,000. So we do not scrap all of the equipment, only a portion of it. Then in note number 2, there's assets that's revaluated. In this instance, it's only land, and they give you the fair value of land is 1.5 million. Note number 3, they say all the buildings are sold on 28 February 2015 for 2.8 million. And then in note number 4, they say that the value of vehicles deteriorated significantly due to new models that were introduced in the market, and the following is provided. They give you a fair value less cost to sell and also a value in use. If we see the terminology, we know we're busy with an impairment loss that needs to be measured in terms of IAS 16. The required part, excuse me, it says that you need to disclose the property, plant and equipment journals for 28 February 2015. And then in note number 2, you need to do the PPE note on 28 February. You should only include land, buildings, and vehicles. Very important. You can ignore comparatives in terms of IAS 1, and then the total column is not required. So you do not need to add up all your totals horizontally. This is very important information because you don't want to waste time on things that you will not get any marks for. So I've opened a spreadsheet, and I want us to look at the calculations. And I am busy with the first note, which is for equipment, and it says that on 28 February we need to scrap equipment with a cost price of 100,000 rand. So if I do a scrapping, very important to remember, the first step is that I need to measure depreciation. So there I will debit the depreciation, I will credit the accumulated depreciation. So if I look at the asset is worth 100,000 rand. They say the useful life is 10 years. And now we need to go and count for how many months we've had the asset. If I look at this question, we only got the equipment on 30 June 2014. That means that we've not had it for a full year. Because the current year that we are busy with is 1 March 2014 up till 28 February 2015. So if we got this asset on 30 June 2014, we got it somewhere here in the middle. So I have to go and count then 30 June until 28 February of the next year, and that gives me a total of 8 months. So I need to go and times by 8 out of 12. If I do that calculation, the depreciation for the scrapped asset adds up to, let's see, divided by 10 times 8 out of 12, I get 666.67. And of course the credit must be the same as the debit, 666.67. Right, the next step is that we need to go and de-recognize this asset because it is being scrapped. And the first step I do is I take out the accumulated depreciation of this asset for the entire time that I've owned it. And because I've only had it for 8 months, it means that this is the only accumulated depreciation that I was able to measure. If I had it in previous years, I would add up the accumulated depreciation of previous years plus the current 6666.67. The other thing I need to do is I need to de-recognize the cost. So I'm going to credit the equipment, and the cost price of that asset that is being de-recognized is 100,000 rand. Then I need to recognize that there is an inflow from the insurance company, and they say that the equipment was insured for 70,000. So they do not say per se that it was already paid. So I will have to accept either bank or debtor. So I need to accept either bank or the debtor account, because it's either still owing or they have already paid it to you. But the total there is 70,000. So now I need to go and measure, am I making a loss or am I making a profit? And if I look at this journal entry, the 100,000 is more, and it seems like I short a debit. And in the instance of a debit, I'm going to debit loss on scrapping, and therefore I will have an expense measured here, and the expense will be the 100,000 minus the other amount, and that means I'm running here at a loss of 23,333 rand. It's important to remember that we should also now, since it's year end, we must also measure depreciation on the remaining assets that still are there in terms of equipment. So I'm going to debit again depreciation, and I'm going to credit accumulated depreciation on equipment. And I need to go now and see, but what is the remaining? So the total equipment was 500,000. I sold or I scrapped equipment worth 100,000. So that means there's still 400,000 rand worth of equipment that needs to be depreciated at year end. So I'm going to take the 400,000 divided by 10, and I've also had this for 8 months because the entire 500,000 rand worth of assets were purchased simultaneously. So they're 8 out of 12, and that gives you a total of, let's quickly see, that gives you a total of 26,666.67. You can also round it to the next rand. They did not give any rounding instructions. So this would be your journal entries in terms of equipment. Right, moving on, the next entry that I see there is with regard to the land. And they say that land is revaluated. So if we look at note number 2, land was revaluated for 1.5 million. And the original price that we paid for it was only 1 million. So you will see that the difference there is then a total of 500,000, and the asset land needs to be increased then by 500,000. So I'm going to do this general entry. This is also on 28 February 2015, and I'm going to say I debit the land because there's an increase in the asset, and I will credit the revaluation reserve. You can alternatively also say surplus. And the difference there will be the current 1.5 million minus the 1 million that we got it for, and that gives us a revaluation amount of 500,000 that needs to be recognized for land. So that's the only journal entry that you should do for land, because land is not depreciated. It has an infinite useful life. Then the next note that I see there is note number 3, and this is also on 28 February 2015, and here we dispose of all our buildings. So we sell them for 2.8 million. So now it's important again to follow certain steps, and the first step in a disposal or a scrapping is to measure depreciation. So I'm going to debit depreciation. I'm going to credit the accumulated depreciation on my buildings. And all of them will now be sold, and the total value there is 2.5 million. I minus the residual of 100,000. The useful life is 25 years. And now I need to go and look for the number of months. So when did I buy this asset? 1 April 2013. This does not fall within our current financial year, 1 March to 28 February 2015. So therefore, it was already with us at the beginning of the year, which means that we will depreciate it for a full year, which is 12 out of 12. When I perform that calculation, 2.4 million divided by 25 years, I get 96,000 depreciation to be measured. Right, the second step is now to go and de-recognize this asset, because it is quite important that we take it out of our books when it no longer belongs to us. So we're going to start again by debiting the accumulated depreciation. And now we need to be careful. We cannot just take the 96,000 as we've done with the 6667, because we've had this asset for longer than 1 year. So for the current year, the depreciation was 96,000. But I need to go and do a calculation then for the entire lifespan that I've had the buildings for. So I'm going to take here on my right hand side and do that calculation. So if I look at the buildings, it is said that it was purchased on 1 April 2013. The first year end after 1 April 2013 would have been 28 February 2014. And if I count the months 1 April 2013 to 28 February 2014, I get a total of 11 months. Then the next year would have been 28 February 2015. And this is the current year, and we've just put 12 months for it. And as you can clearly see, the difference between these two dates is 12 months. So we've done a calculation for this 12 months, and we said that it is 96,000. So what we need to do is perform a calculation for the previous 11 months that we had it for, and then add those two together, because all the accumulated depreciation needs to be taken out. So in this instance, I'm going to calculate for the 11 months, and there I'm simply going to say it's the 2.5 million minus the 100,000. I'm going to divide it by the 25 years. And I'm going to times it then by 11 out of 12 months. So when I do this, I get 88,000. So the total amount that I need to take out is the 88 plus the 96,000, which is 184. So this total 184 is taken out of my books. Then I need to de-recognize the cost price, so I'm crediting the buildings, and that is a total cost price, because all of it is disposed of 2.5 million. Then they tell us that it is sold at a price of 2.8 million. So again, I'm not sure if it's bank or debtor. So I need to mark either one of those, 2.8 million. Right, so now I need to go and see which side I need an entry. And it seems to me like the credit side will shorten entry. So I'm then going to credit profit on sale. And this is going to then be the difference between the amounts in order to obtain a balancing figure. And I get that amount to be the 48, just set it to the right font, 484,000 for the sale of the buildings. And there we have then answered the note in terms of the buildings. Note number 4 relates to the vehicles. And it says that the vehicles have deteriorated in value, and they give you the fair value less cost to sell and the value in use. So if I perform an impairment loss, there's several things I need to do. I'm still on 28 February. And there's several things that I need to calculate before I can just jump into performing journal entries here. So there's actually 3 steps that you need to do. And step 1 is you need to recognize the higher of the 2 values. So we have fair value, less cost to sell, and value in use. If you look at the question, it's 100,000 and 120,000. So the higher one I need to take is the value in use, which is 120,000. And it doesn't necessarily always have to be the value in use. They give you the fair value, less cost to sell, and the value in use. You always take the higher one. Then note number 2 is to calculate the current value of the asset, or the carrying value at year end. So here we need to go and see what is the cost, what is the accumulated depreciation, what's the carry value at the beginning of the year, what is the current depreciation, what is the carry value at year end. Right, so the cost price is easy. That was given to us as far as 650,000. Then I need to go and calculate the accumulated depreciation, but before I can do that, I need to go and count the months until the beginning of the year. So let's quickly do that. If I look at the purchase date of the vehicles, it's 1 December 2013. So the first year end thereafter would have been 28 February 2014, and then we would have the current year 28 February 2015. So clearly the difference for the current year between 28 February and 28 February is a total of 12 months. But what is then the difference between December and February? The difference between those 2 dates. So it's going to be December, January, February, which is a total of 3 months. So for the accumulated depreciation up till the beginning of the year, we account for 3 months. And for the current depreciation, we account for 12 months. So in previous years, we only owed it for 3 months. So that's going to be the 650,000. There's no residual value. We can use it for 5 years, and we're going to times it by 3 out of 12. When I do this calculation, I get 32,500, and that gives me a carry value at the beginning of the year of 617,500. The depreciation for the current year is based on 12 months. So there I will say 650,000 divided by 5 times 12 out of 12 if you wish. And that will be 650,000 divided by 5. You can just times by 1 because 12 out of 12 is 1. And that gives you 160,000. So the carry value at the end of the year is then the carry value at the beginning of the year minus the depreciation, and that gives us a carry value of 487,500. Then finally, we need to go and measure the difference, or how much it's been overstated. So in step 3, I say, all right, the value is 487,500, and it should actually be step 1. 120,000. So I minus 120,000 to see by how much it is overstated. And it's overstated then by a total of 367,500, which then represents your impairment loss. So in terms of general journal entries, I'm going to account for the current depreciation. So it's that entry, and I'm going to account for the impairment, which is this entry. So I'm going to say then I debit the depreciation, I credit the accumulated depreciation on the vehicles, and that gives me that total of 130,000 that I have calculated there. The next step is to recognize the impairment. So I'm going to say I debit the impairment loss, and the credit entry for this is always accumulated depreciation of the related asset, which is vehicles. And we've calculated the impairment there, so it needs to be equal to our calculation in step number 3. And there I have then completed the journal entries for all the assets that were required in my question note 1 to 4. Right, then the next step states that, or the next required part states that we now need to do the PPE note. So we need to do land, buildings, and vehicles. Right, so I'm going to start with land. Relatively simple. They've given you the cost price of 1 million rand. It's not depreciated, and therefore the carry value is equal to the cost. We've had a revaluation. We had to increase it. The revaluation was done in the journal here. We had to increase it to by 500,000 to get to 1.5 million. So the revaluation that we've measured was 500,000, which gives us then an ending value of 1.5 million. Since the depreciation is 0, the carry value together with the cost price will be indicated as 1.5 million. This is quite straightforward. Then for the buildings, we've disposed of all the buildings. So you will see the cost price of the buildings were given to us. It's 2.5 million. And we have calculated the accumulated depreciation at the beginning of the year, I think. Yes, because we said at the beginning of the year there was 11 months, so it was 88,000. So the previous period was a total of 88,000, and that 88,000 will then go and stand there, which gives us a carry value at the beginning of the year of 2412000. Then what happened during the year was that we had a disposal, and we also measured some depreciation. So if I go back to my journal entries, you will observe that the current year depreciation was 96,000. So that 96,000 will come and stand there as a negative amount. Then we need to measure the disposal at carry value. And if I look at my calculations, the carry value of the buildings would have been the 2.5 million minus the 88,000 minus the 96,000. That gives us a total of carry value 2316000. So that's the carry value at the date of sale. 2316. So the disposal minus 2316000. Then you will find we have disposed of all the buildings without replacing it. So at year end, the cost, the accumulated, and the carry value should be nothing, because we've had 2.5 million of buildings. We sold all of them, and if you have sold everything you have nothing left at year end. Then for the buildings, we are done, but we need to move on to the vehicles. For the vehicles, a cost price of 650,000 was given to us. We have calculated again the accumulated depreciation at the beginning of the year, 32,500. So minus the T2500, that gives us a carry value of 617,500. We've measured for the current period some depreciation. The depreciation was 130,000. So minus 130,000 here, and then we had an impairment as well. So if I look at the impairment total, it was 367,500. So here minus 367,500. An impairment loss will always be negative. The cost price of the asset, we've not had a disposal, we've not had an addition, we've not had a revaluation. So therefore the cost price will still be the same as at the beginning of the year. The carry value will be the carry value at the beginning of the year, and then we take all the amounts under movements and we minus or add them accordingly, and the carry value at year end is 120,000. I know this is correct because I had to adjust it to 120,000 in terms of my impairment losses. My accumulated depreciation will then be the difference between the two, which is 530,000. And that was then the PPE note that you had to complete based on the journal entries that you have done. I hope that you have enjoyed this video and that it will help you to understand the concepts of IAS 16 a bit better. Thank you so much for watching, and I will see you in class.